Investors and traders, welcome to the channel Market Chat Pet, and today is 3rd of May 2024. I hope everyone is having a great day. The theme of this video is bad news is good news, and we'll talk more about it, what I mean by that. This video is for educational purposes only and it's not a financial advice. So we are looking at the calendar from forexfactory.com, and here I just wanted to point out we had the non-farm payroll data come out today, and we also had the ISM services PMI data come out as well. So on the non-farm payrolls, the data was a little bit softer. Around 175,000 jobs were created, which is much less than what was expected, which was 238,000, showing softness in the economy. And look at this, the unemployment rate. The unemployment rate actually went up a little bit. So expected was 3.8%, and what came in is a figure of 3.9%. And again, if you look at the ISM services PMI figures, what was expected was what was the forecast was for 52, and what came in is a figure of 49.4. Again, a softer figure than what was anticipated. So again, it is a bad news in a way that it shows some softness in the economy, and with the unemployment rate going up a little bit and lesser jobs getting created, that means it's not such a good news. However, if we look at the stock market, the reaction to the stock market, the market actually was higher for the day. The dollar was lower for the day, and the bonds rallied and the yields came lower, and gold was flat. So this is what we're going to take a look at, and this is what I meant by bad news is good news, in the sense that softer data coming out, but the market was actually higher. So this is a daily chart of dollar index, and this is the key chart that we were taking a look at in our video yesterday. And what I was pointing out was this 38.2% retracement around 105.35 level being very, very important. And what it means is that moving below this, in my opinion, it means that we may have seen a pretty important high in the US dollar, and the US dollar is likely to actually move lower. And this is what we have seen. We have actually seen 3 consecutive days where the dollar has moved lower, with today being a really close, a really key day where the market has actually closed below the 38.2% retracement of this swing low to this swing high. All right, this is the double top formation as well. For the second consecutive day. So this is something really important. Now, if we just go back to this high, which was formed on 3rd of October 2023, and this was the consecutive high of November 2023, and this is the time period in between the stock market had actually bottomed and had a fantastic rally, which seems to be still going on. So this is something we need to pay attention to, because what we have is market rallying into this gap right in here. We were expecting maybe the market could go as high as 107, but the chances for that are lower now, and I don't think that will happen, and we might have seen a pretty good top, which is likely to last for several weeks to months, in my opinion. And it is also a double top formation, just like the kind of double top formation we had here. This was a much spectacular double top, because here the market tested the highs one more time on the 1st of November, and then on 2nd of November, when the market opened, it actually opened with a gap. And this is what this market has done now. On 1st of May 2024, the market went and closed this gap. It just went right into it, where we also had a 1.618 Fibonacci expansion of this this swing high to this swing low. And this is really important. If the market keeps on trading below this 38.2% retracement, then in my opinion, we have seen a pretty important high in the dollar. Now, if we just take the opposite of it, because the dollar index is about 50% composition of the currency euro, which is used in the European Union. And now what we are doing is we are taking a look at the Euro USD daily chart. Here, one of the key things is that we have a very prominent downtrend line which is present here. This seems to have capped every rally, and these rallies have actually come at really important Fibonacci retracements and pattern formations, and whenever there has been a confluence of one, two, or more pattern formation or the ratios coming together, that has tended to be a pretty strong support or resistance level. Just the way around here on the 8th of March, it was ABCD, really nice one-to-one price projection right at the 61.8% retracement, and the market went lower for several months. And now what is happening is that one of the things we were watching for was you see this purple line, that's one ABCD formation, which could take us to as low as 105.40 level. Now the chances for this to happen are actually much lower. So I'm gonna go forward and actually remove this, and the reason is I think where the market is right now, it has been trading like this since 16th of April 2024, so it's been a couple of weeks now. That was a pretty strong support. And the reason for this is it came right at the 78.6% Fibonacci retracement from this low of 3rd of October right to the top of 28th of December 2023. And then what we have is we have a confluence of a smaller ABCD pattern coming here. So you see this black line. So you take this high of 8th of March 2024, the low of 2nd of April 2024, and you just project it from the 9th of April 2024, and we get to a price level of around 106.20. Further, we have the 1.272 Fibonacci expansion of this swing coming in around 106.17, and 106.20 is also the 1.618 expansion of this smaller move right here. So essentially I've tried to highlight this for you guys to make it easier to visualize in this blue or cyan colored triangle. And here I've also written the confluence of number of things coming together. So we have 78.6% retracement, we have the one-to-one price projection, which we like to label as ABCD, 1.272 expansion, and 1.618. So we have got 1, 2, 3, 4 things coming together, and it's likely to be a pretty significant support in my opinion. Now the key thing is that because of this trend line, to be conservative, if it is broken to the upside, so let's say the market is able to close above 108 108.15 level, and especially if it's able to do it on 2 consecutive daily basis, that's gonna give us a pretty strong level of confidence that you know, we might have seen an important low come in the euro currency against the US dollar. And this break of the trend line is gonna be another tool in our kit which we'll use for this purpose. So keep this in mind, and we'll come and revisit this when we begin to you know, move further in our daily analysis over the course of next weeks and months. We'll also quickly take a look at the Bitcoin market. So here we go. So there we go. So the Bitcoin, we were really watching for this 38.2% retracement coming in roughly around 60,000. The market went low, pretty much very close to the 50% of this entire move higher. And what we see now is this market also recovered, and it's right into the resistance coming in from the moving averages. I've not drawn the Fibonacci retracement. Let me actually try doing that. So I'm just going to take this high, and we can see that it is in my opinion pretty much right at the 38.2% retracement. Yeah, this is actually where the market closed, and you can even argue if we take the higher high, this is where it reached right to 63,000, is right the 38.2% retracement from these all-time highs to this where the market actually reached today. So nothing surprising, right into the moving averages. It's gonna have some resistance. So we'll just keep on watching this really carefully, because it also means that if it begins to close above the 63,000 level, the Bitcoin might be starting another leg higher, and we could have an easily ABCD, which could take this much higher, over 100,000 or 100,000. Hard to believe, but this is what the patterns will tell us. So we'll watch that really carefully, whether it'll transpire or not. It needs to be seen. Now, really important, which we will begin to take a look at the price action on the yields. So we'll start by taking a look at the shorter term 2-year treasury note. This is the chart which I had shown you guys yesterday, and in that the pattern that I showed you was this. So we have ABCD. I'm not going to go into the detail of this pattern because the video will get really long. I'll just recommend you go and watch yesterday's video. I'll put a link to that video towards the end of this video so you can scroll to the end, and also try to put it in the description as well. I think you'll find it really nice video from an educational perspective. So we have our 1-to-1 price projection come right at the 78.6% retracement. We have had, so this is today's price action, right? Look how the yields were slammed lower, and of course today is Friday. It's also the end of the week. There is some profit taking. Some players might not just want to carry some risk over the weekend, so they just might take the profit which is available to them, so that sort of thing. But it came right from this pattern formation, so this is something which we have to respect. Further, in my opinion, there is quite a lot of symmetry between the left shoulder and the right shoulder, and this is the head. So in my opinion, this is also a head and shoulder pattern formation. And now what we are really watching for was this trend line that I've drawn in blue, and the market closed slightly below that, but it went a lot further below this. And the other point that we had discussed in our video yesterday was this around 4.7% level, because that's this 38.2% retracement, and it's right into this structure which was once resistance, and resistance could possibly support. The market went right into it, and then there was a knee-jerk reaction where some profit taking took place. But important thing to know is 3 consecutive closes in the negative. So we'll be watching this space really carefully, because on the longer term this pattern calls for the yields on the 2-year note to go down as low as 3.9%. 3.9%. Now there was a video that I had done, it's quite old now. It was done about a year ago, a little over a year ago, coming to maybe 1 year 3 months mark. And in that I was just trying to show that Fed really likes to follow the 2-year treasury note. And if the yield in the treasury note is actually falling like this after making a secondary high or a recovery high around 5%, which is a significant level on the 2-year treasury note, then the market is just telling us something that the Fed is actually, if they're not going to be able to do a rate cut, because we are getting really close towards the election period as well, and Fed might not want to appear as a political party, or which can influence some political things, again not my subject. Then what they can do is, even if there is hotter inflation data coming out, they will not raise the interest rates. That's going to be the other side of the equation. So what it means is that this is what Jay Paul said in the meeting when reporters asked this question, and I think you can Google about this. He said something to the tune that the Fed is not looking to hike the interest rate. So that takes an element of fear that if there is going to be a inflation data which is coming harder than expected, the Fed might actually increase the rate. But this is coming from chairman's own words, that they're not likely to do that. They're not going to do that. So that's pretty comfort for the markets. And on top of that, we have some softer data coming today. So you put these things together, and what we see is a lower dollar, so weakness in the dollar, US dollar, euro getting stronger, and we see a fall in the yields, so 2-year treasury note. And if the dollar is getting weaker, the yields are falling, then it should also help risky assets such as stocks. So we'll talk more about that, because there's a possibility that the stocks actually might continue their rise higher, and they might actually continue to rally in the summer in short. So we'll take a look at that. We'll cover more of that in the weekend video. Otherwise this video gets really long. Okay, So now what we'll do is we'll take a quick look at the 30-year bond future. So this is the longer term, this is the 30-year duration, and you can see that it looks like now the market again closed right at the 38.2% retracement level. So we were saying that it really needs to close above 116, and if it does, and then in my opinion we should be in this CD leg higher, which could be a multi-week to multi-month move higher, taking us right into the region of 131.05 to as high as 132, roughly speaking. So it looks like we might actually be starting that sort of a move higher now, because we have the price actually closed above the 20-day moving average. It really needs to close above 116 in my opinion to take a conservative view on this. Okay, we'll also take a look at the TLT. Now TLT, this is an ETF. iShares 20+ year duration bonds are part of it, so longer duration. This is the pattern formation which we discussed yesterday, and we had a rally here as well. Now, just like the 30-year bond futures, needs to really get above, in my opinion, above 92.40. I've actually written here. And that's really important because the market symmetry concept. So but I'm not going to explain that in this video right now. This is what needs to close above to actually confirm to us that it's actually in this leg higher. Okay, now we'll move to the stock market. Excuse me. And we start by taking a look at the S&P 500 cash market. Okay, so this is the cash market, and what we can see is, compared to where the market closed yesterday and where the market actually opened and closed today, there's a pretty big gap here in the cash market, and the gap is to the upside. The market has actually closed above the 20-day moving average, and you know, if it just hovers around here for some time, then the 8-period moving average is likely to catch up with the 20-period moving average, and if it closes above that, then that's pretty strong signal for momentum as well. So here the pattern that we were watching for is that maybe it's able to get as high as 51.50, which is 61.8% retracement. It has already completed this ABCD pattern, but it's also possible that it's also doing another ABCD pattern formation like this, which could actually see this one take it right to the 51.50 level, which is the 61.8% retracement, and that's going to be a pretty important pattern formation because of the 61.8% retracement. And also on the 1-hour chart, I had shown you that, let me show you again, that it is actually, the market appears to be moving in this channel formation. So it is also going to be the upper end of this channel coming around here, so that's going to be a key level. My perspective is we are really watching the low of the 19th of April, and then the low which formed on the 2nd of May, because essentially these are higher bottoms, right? These are higher bottoms, and this is a pretty strong resistance around 51.50. The chances if the market gets there, we might still get a pullback, and the pullback could be a little significant. It could be a pullback of 30, 40, 50, 60 points, or we could have that day where it just went lower by 100 points. I'm not sure whether it'll happen or not, but the chances are that it's going to be a pretty strong resistance level, and we might get a pullback. We'll have to really carefully watch that pullback, because that is going to give us a lot of information whether that pullback is just going to be something like this, where we also get a gap fill, and then the market is forms a micro bottom with look, if you look at this is micro double bottom. So if it is not able to take this bottom out, then the chances are, because what we are seeing in the weakness in the US dollar, some softer data coming in, the yields moving lower, then the chance is that we might have seen an important low come in on 19th of April, and the market actually begins to rally throughout the summer. So that possibility is actually gaining traction. There were 3 scenarios. I'm not going to go into the details of those, which we had discussed in the weekly video, and we'll just cover those again, but I'm just trying to put things together based on the movement in the US dollar, what we have seen thus far, and the yields moving lower as well. So This is for the S&P 500 cash market, and if we just look at the futures, here we go. You can see that pretty strong move. In fact, the market took out the highs of 29th of April, so that's good for the bulls, and we are just very close to the 61.8% retracement, or 51.95. Getting above this is bullish. Then we could have an ABCD, which would in fact take us right above here, close to the 78.6% retracement. But again, as I mentioned, the 51.95 could be a pretty strong resistance level, so we'll have to watch for this. It might just produce at least some sort of a significant pullback at least. If we move to the NASDAQ 100, and this is the chart for the futures daily chart, again we can see that the market has gone above the ABCD. It's very close to this 61.8% retracement. In fact, we were watching for 18,000 level, and the market is there. So looks like the tech stocks are signaling if there's going to be strength here. If they're able to get through this, then we might have seen an important low come in around 19th of April, and the stocks might carry on rallying throughout the summer. That possibility will begin to gain more traction. So we'll discuss more in the weekly videos. And then Russell 2000, let's take a look at that. It had a fantastic rally as well, but what it has done is just completed this ABCD formation right at the 61.8% retracement. So 2070 is really important. If it gets above that, then we could be looking at this ABCD move higher, which we had discussed as a possibility, because this one also formed this double bottom formation around here, and it had actually been respecting this 38.2% retracement. And then if we look at the Dow Jones really quickly, the Dow Jones, I think it's going to go and test this 61.8% retracement, 39,260 level. And if we look at NYA, which is the New York Stock Exchange Composite Index, we also see strength in here, but it's just testing these highs from, I believe this is the 50%, but the ABCD pattern is still higher, a little bit higher over there. Now the key thing is that you see this micro double bottom come in. So these two, this is micro double bottom, and then we had a low on the 25th of April. The market has not taken this one out, so it's moving in this ABCD formation, but the momentum seems to be improving quicker for this one, because it also has ADRs, also stocks which are of foreign companies trading on New York Stock Exchange. So last but not least, let's take a look at the gold market, because the gold market is really interesting. Why it is so interesting, and not just because we have seen a really strong move to the upside, but what we have also seen is that this market actually, when the dollar was pretty strong, this market was pretty strong, and then it reached certain key levels of 2450. It has a little bit of a pullback around here. We could see the pullback come down to around 2275. It came pretty close. I believe the low was today 2285, so it missed it by about $10, which is important because it's possible that might have been a pretty good low in this market. Now the key point that I want to bring is that because the dollar at one point was pretty strong, pretty weak, and it had a pretty strong move down when the data came out for the NFP and also the PMI figures. And one would have expected the gold for gold to rally a fair amount and at least close positive, but the gold did not. So with the dollar being lower, especially for 3 consecutive days, gold, it has not shown that much strength. So this is why we really need to pay close attention to the gold market. It has come very close to the 38.2% retracement. There is a possibility of this ABCD, which sees it moving a little bit lower, maybe around 2235. But there's also a possibility that today's low of 2285 was very close to the 38.2% retracement that we were watching for. So now if on the daily basis, if it's able to begin closing above this, forms like a nice bullish candle, then that the chance that we might have seen an important low come in the gold market, the chances will increase, in my opinion. And then of course we'll have to wait a little bit for the momentum to increase, because we really want to see the price close above the 20-day moving average, and ideally with the 8-period moving average above the 20-day moving average. It's a pretty strong momentum signal, in my opinion. So this is what we are watching. Apologies again for the long video, but there was a lot of information that we had to talk about, and I will do the weekend review on Sunday, and we'll just cover things in more detail, and especially the kind of three scenarios that we were watching for the stock market. But it had been an amazing day today, because a lot of data came out. In fact, throughout this week there was a lot of data which came out. The picture is forming, is getting more clear now. Some of the trends that had been in place for a few months, a couple of months to 3 months, maybe there is some reversal developing, such as the weakness coming in the US dollar, some of the yields on the lower end of the yield curve, and also on the longer end, such as the long bond futures, seems to be pulling back, and that could have an important impact on the risky assets. So thank you very much for watching the video. If you like our technical analysis, how we look at the markets, then please do think about subscribing to the channel. And if you find this video of educational value for yourself, give it a thumbs up. So thank you very much. Good luck, good trading. Speak soon.